What's up, guys? Tired of your InsurTech solutions coming up short? We've seen tech services that aren't industry specific, just some tech firm slapping an insurance sticker on it, but not really understanding our business. We need an agency-centric solution. Technology is built by insurance pros for insurance pros to streamline our processes. A great example of that is ePayPolicy. All these guys do is insurance. That's their only focus. They are a great go-to service for ACH and digital credit card payment processing that helps you bind policies faster, and they seamlessly integrate with a ton of management systems. Head on over to epaypolicy.com, check them out, and use the promo code IGPodcast to get your first month free. I don't know that Elon Musk is working on a self-driving insurance agency, but until he does, we've got ePayPolicy. It's like being on autopilot. Flip the switch, lean back, take a nap. Let's go. Hey guys, I just wanted to give you guys a heads up of this week's episode on the cycle of insurance with Bill Cochran. For those of you that are super insurance nerds, you will get a lot out of this episode. Something happened and we actually forgot to release this episode, so this is just kind of a heads up that this was recorded 6 months or so. Really hope you enjoy it. Thanks so much.
Insurance agents from around the world, welcome to the Insurance Guys podcast. My name is Scott Howell, your fearless host and leader, insurance agency owner and insurance evangelist for iProtect Insurance and Financial Services, based out of Huntsville, Alabama. And before we get started on today's episode, please help me welcome. He is a 6'3" sophomore from Saraland, Alabama, Parade First Team All-American, Rivals 5-star recruit. He is a fantastic insurance agent and a great American. Ladies and gentlemen, please stand and welcome the incomparable Mr. Bradley Flowers. How are you, Bradley?
Great, Scott. How are you today?
Man, I am doing the best. We just all ate crystals, so I'm sure we'll all be headed to the bathroom here in about 15 minutes. We have had
You have to do what you have to do when you're doing 8 podcasts in a day.
Absolutely.
To get lunch.
Absolutely.
I'm one of those guys, if I miss lunch, the rest of the day is just not good for me.
Right. You know, yesterday I passed up lunch thinking that we would be through around 3 o'clock. And I think I walked into our favorite Mexican restaurant down the street about 6 o'clock last night and finally got something to eat.
Well,
so it was a long day.
We actually had a podcast cancel yesterday at the end of the day, so it would have been even longer.
Absolutely. Guys, I'm excited about our show today. I've got a guest on here that means a lot to me, probably more to me than he knows. And I am excited about the topic today because 2020, I want to cover a lot of material that we haven't talked about in 100 episodes of different podcasts that we've done. And I'm humbled and blessed to have him on here today. You know, there are a handful of men and women that when I think about the Webster's Dictionary definition of a real insurance agent, you know, what a real insurance agent is, this guy falls into that category. You know, if I can be half of the insurance agent that he's been during the course of his career, I will have felt very proud of myself by the time this thing all shakes out for me. But without further ado, I want to introduce our guest today. He was born and raised and currently resides in Florence, Alabama. He is married to the beautiful Lisa Cochran, and they have 2 children, Carly and Kyle. He is a 1981 graduate of the University of Alabama, where he studied insurance, commerce, and business administration. He began his career with Nationwide Insurance on August the 4th, 1984, and he has been an agency owner since that time. Ladies and gentlemen, it is my profound honor to introduce today my friend and one of the best insurance agents that I've ever had the pleasure of getting to know. I give to you the incomparable Mr. Bill Cochran. How are you, Bill?
I'm doing fine, Scott. Where do I send the check for that nice introduction?
Well, you don't have to send a check, and I'm going to say some things here on air that we talked about the other day off air. But when I joined Nationwide in July of 2010, I can count on one hand the number of agents that really I felt like wanted me to succeed and were the kind of people that would pull me aside and have conversations with me after meetings and things like that. And you were one of those guys, and I've always been very appreciative of that, and I've been thankful for that. And I want to say that on air. One of the smartest guys I've ever had the pleasure of meeting. Your take on things is always very rational and reasonable. And also, and this is why I led with this on the show, you're one of the most respected insurance agents in your community that I've ever met. I have never met anybody from Florence, Alabama that doesn't say anything but nice things about you. And
Well, thank you.
which probably why that your retention ratio is about 100%. I know you've always enjoyed an extremely high retention ratio because of your kindness, your presence in the community. You've been there your whole life, so you know a lot of people there, and people really respect you, and that means a lot to me. And I don't know, when I think of great insurance agents I've ever had the pleasure of getting to know, you were up there in the top 1%, obviously. But today, guys, we're going to talk a little bit about something that Bill taught me in a class probably 7, 8 years ago in Huntsville, Alabama. And it's something that's always stuck with me, and it's something I wanted to share with our listening audience of both captive agents and independent agents. We're going to talk a little bit about the insurance cycle. And, a lot of times, Bill, agents get pissed off when 4 or 5 years into it and they've been selling a lot of insurance, and all of a sudden the company takes rate. They wake up one morning and they get an email that we're going to raise rates 10%, 12%, 15%, whatever it is. And I just wanted to talk to insurance agents today with you because you're so knowledgeable about this particular topic, kind of that insurance cycle and how that all works. So I'm going to shut up and listen, but just talk to our audience a little bit today about, how that starts and then kind of how that cycle ends, if you will.
Okay. Well, the first time that it was introduced to me would probably have been 1979, 1980 in one of my insurance classes with Dr. John Bickley at the University of Alabama. And at the time, it was good information, but the most important thing was that it helped me get through the test, get through the exam.
Right.
And really didn't live it.
Right.
Once you get into the insurance business, I find it interesting that, it's where we live. It's where we play. It's what we do in the insurance world. And the insurance cycle, or the underwriting cycle, as it may be referred to, is it helps you realize where you are. Helps you realize not just where you are, it also helps you realize where you're going or what's coming next.
Right.
And so those are things that I found to be useful in that it helped me maybe make decisions about my agency operation a little bit down the road, what I was going to be doing. And I will, get into a little bit more detail about it. But I don't think in 35 years I've ever used anything about the insurance cycle to close a sale or anything.
Right.
And I don't think you'll hear it come up too often in a sales presentation, but it can be beneficial when it comes to agency management.
Sure.
But anyway, kind of backing up, in general, what the insurance cycle is about is the characteristics of the insurance industry, the insurance marketplace, as it moves from a soft market to a hard market, and then back to a soft market again.
Right.
And all points in between. If you can envision a watch or a clock, the face of a clock, there's a lot of different ways you can break it down, but it was initially broken down to me in 4 different terms, and it just kind of gets you a visual picture of it. If kind of go with the clock concept. At the 12 o'clock position, you write down the word profit, and at the 3 o'clock position, write down the word growth. At 6 o'clock, losses, and at 9 o'clock position, underwriting. So,
Bill, do me a favor and say that all one more time. I want to write this down while we're talking. And insurance agents, I know we've got somewhere between 25 and 50,000 insurance agents that are listening to this right now. I'm going to encourage all of you to do what I'm doing right now and write this shit down, because what we're giving right now is a master's class on this. So go back. We're looking at it like the face of a clock. Go ahead and go from there again.
Face of a clock at the 12 o'clock position, write the word profit. At 3 o'clock, growth. 6 o'clock, losses. And at 9 o'clock, underwriting. And for other reference too. I mean, there's a lot of information out there on the web about the insurance cycle or the underwriting cycle, and they'll have different or similar terminology or like I said, they may have more, but there's a lot of diagrams that will help kind of explain what it's about. But basically, so when you look at the underwriting cycle on paper, what it's telling you is that when a company or when the industry is in a high profit position, it positions themselves for the next phase, which is growth. And then when you go into the growth stage, and we'll touch on some of the characteristics of each stage in a little bit, but when you go into the growth stage has a tendency to lead to increased losses. And then so as you move toward that stage, when the companies or the industry starts realizing that that losses have crept up or moved up, then it returns you back to an underwriting stage where you enact different programs to try to return you to profit. And then once you're back to profit, you're positioned for growth, and here we go again.
Right.
And that's the cycle. But the other thing about the cycle too is, while you may be in a position of profit, moving toward a period of growth, it may move in a counterclock position too. Depending on what the activities are within a specific company or in a specific market, you may see something return backwards. You could see that for a little while before it progresses in a clockwise fashion again.
Is that particular scenario where you're at the 12 o'clock position and profit? And what I've noticed, and correct me if I'm wrong, is when I hear companies talking about working on profitability, that is a code term for we're going to take rate, right? I mean, is that pretty much?
Yeah, that's right. Because that's part of what you see in that phase between the underwriting portion of the cycle and the profit is you usually see rate increases, some other actions that again we'll touch on in a minute. But, but yeah, that's rate increase is usually something that has led to that.
Is it a little bit of an anomaly to see a company go from quote unquote the profit phase back towards underwriting in that counterclockwise motion? Is that a little bit of an anomaly, or is it usually that clockwise motion?
I don't know that I can address that from a factual standpoint, because I can't think of being in a situation where I've lived in that moment. I have, and this is a term you're probably familiar with, Scott, the term profitable growth. Have you ever heard that before?
Oh yeah.
And that is a phase where I think I have lived in that, where as a company was moving toward a growth attitude or position, then they couldn't let go and just really grow. And they would always hang on to things that were a little bit on the underwriting side, trying to maintain their profitable position. I used to say those were contradictory terms because profit and growth don't go together in general, because a lot of times on growth, you have probably heard before that, as they analyze where losses are coming from, new green business in a portfolio has a tendency to have a higher loss ratio than seasoned existing business in a portfolio. So if you're going to grow, you're probably going to be a little happier and less surprised if you expect losses, because in the insurance cycle, that's what's coming after the period of growth is increased losses. And it's kind of opposite of what you were talking about on the profit side of having rate increases somewhere between that growth and moving toward the loss position out there. You see rate decreases, and maybe even to the point of being underpriced to try to get business on the book so you can raise that rate up as you move back to the underwriting side of it.
Right. Absolutely. What I've always found to be the case, and this is why I wanted to talk to these agents about this, I don't think it's something a lot of agents think about as their writing business. And, we all want to do the happy dance in our office when either the company that we write a lot of business through takes a rate decrease, or we've got the lowest rate in our community and we are just writing the hell out of insurance. And you can kind of see this insurance cycle in your agency with different carriers, you can kind of see like, if I'm Bradley Flowers and I'm writing a bunch of business through a company like Safeco, let's say for instance, and I'm just throwing that name out there, and you're just writing a ton of business, get ready, because you are somewhere on the continuum. You are in this insurance cycle. So for a period of time, and you can kind of go through that with us, Bill. I don't know if you know any statistics of how long that growth phase happens, but you may have the best rate with that particular company, and then at some point in time, the losses are going to start adding up, and now we're starting up the clock towards underwriting. And the first thing I notice when we come out of that growth phase is you'll go to write a piece of business, and the underwriter will be like, well, we're going to need this, and we're going to need that, and we got to have this, and that's not going to work. And you start seeing what I call that hardening of underwriting going on, right? Is that correct?
That's correct. That's correct. And you make a good point there. Right now, I would say, at least from the agency experiences here, we're in a growth cycle.
Right.
And most carriers are.
Right.
And so you know what's coming next. And but the point that I thought you made that was good was the time frame. Now, over the past 35 years, it always seems like, and this just kind of arbitrary, but it seems like if you spend 3 years in the underwriting part of it, you spend 1.5 years in the growth.
Right. Yeah.
It seems that way anyway.
It does. Yes.
It seems like you spend more time battling underwriting projects so that they can become more profitable than you do in the growth segment of it. And again, that seems like, if I charted it on a calendar, maybe that's not. But yeah, then, and the couple of ways of looking at it too is you can look at the cycle as it relates to the industry as a whole. It kind of, if you pretend that there's only one insurance company and it is called the insurance industry, what's its trends, what's its losses, what's its investment return, so forth. But you can look at the industry as a whole. You can say, what is it in my territory, in my state? What's the what part of the cycle is the market in the state of Alabama versus the state of North Carolina, and then within a specific company, where is the company in its underwriting cycle? And then maybe try to ask the question: is it in step with the industry, or is it out of step with the industry? And what I mean by there is the market in your state, in your territory, in the industry generally in a underwriting part of the cycle, trying to return to profit, but your company that you're your main company or two is in a growth cycle. Is it out of step? Not long after I got into business in the late 80s, we found ourselves in a very big growth cycle, at least in commercial insurance in our state, in our region. And actually, it was company wide, but we found ourselves in a very big growth market, and the rest of the industry was tightening up. And we were not as reactionary to that, so we were out of step. And it was a lot of fun. From about 1985 to 1987, I think April of that year, it was a lot of fun. And being a relatively new agency at the time, it really made things good. But then April of 87 rolled around, and we were hit with the moratorium. Right, no more. We've got to figure out what we have. And just as an example, I don't remember an exact number, but in our 3-state region of which at the time was Georgia, Florida, and Alabama, on May the 1st of that year, they had between 15 and 20,000 new business applications that had been submitted since the first of that year that had not even been looked at yet.
Wow.
Business bound on the book, money collected, but not completed through the underwriting cycle. It was that kind of growth. And they just had to put the brakes on and shut us down basically for almost the rest of the year. And then when we came out of that, we were moving rapidly into the underwriting portion of the cycle. And, and that portion, I kind of go and open the door and get into that portion, rates start to rise, risk selection processes tightened up, activities to make business more profitable increase, whether it's, checking driving records, checking the business classification codes to see which ones are more profitable or less profitable. So you're getting new business rejected or guidelines changing to say it's not eligible anymore. And you're getting accounts non-renewed, sometimes not because of any fault of their own. They're just in a class code that they deem less profitable, so they're going to get it off the books. It's not, as you know, it's not a lot of fun when you get into that part of it.
Right.
And that was probably the most significant time that I could ever say, I'm in this part of the underwriting cycle, and it's very real. And it's because it's in the tight side. Things, like I already said, things are a lot more fun when you're in the growth side. But you do get through it. But when you're there and you get the feedback from the companies, from your carriers of, when things are getting more profitable, hey, a better day's coming to write more business.
Right.
Of course, sometimes now, especially now when they close off a company and start writing in a new company with certain types of products, that helps you get a lower rate without seeing your entire portfolio get a lower rate. Instead of just everything across the board having a rate reduction, only the new company tends to, and the rest of your portfolio doesn't decline as much by rate decrease, which helps maintain income, not just for the companies, but for your agency as well. But good source of information out there too, Scott, is the Insurance Information Institute. They've got a good online site. For the best benefit of it, you do, sign up for membership. I've had the benefit of hearing some presentations from their representatives at I-Day each fall at the University of Alabama, and it's some really good information about what's going on in the industry, what the trend has been, what the expectation is for the next 3, 4, 5 year period ahead of us. They also have information about what's going on in the economy and how it impacts our business, our marketplace. It's a good source for information, especially if you like to look ahead or just, again, or have an idea of where, hey, this is where we are, this is where we're going, what do I need to be doing?
Hey guys, it's Bradley with the Insurance Guys podcast here. I know I'm interrupting your podcast listening experience right now, but I have a very important message for you. No singular individual has done more for the Insurance Guys podcast than the man himself, Mr. Chris Paradiso. And as you may or may not know, Chris releases a magazine once a year called Be the Last Agent Standing that is a phenomenal resource for the industry. Guys, you do not want to miss this year's issue. It features some fantastic articles from people like Ryan Hanley, Bob McCool, and even myself. And if you want to get your hands on a copy before they're all gone, text the word magazine to 251-237-9383. That's 251-237-9383. We will send you the link to purchase your magazine. Really appreciate it. Thanks.
One thing, Bill, I've noticed about companies, it doesn't matter what company it is, but the more outside the box that leadership gets relative to when you're in that growth phase, if you take rate that's just unbelievably lower than everybody else and you are just writing like every single thing known to mankind in that particular segment that they want to be in, then the harder things get when you do go back over into that profitability phase. So if you're, like you said earlier, if you're writing a bunch of insurance with a particular carrier and it seems like your bind ratio is like 95%, you've got the lowest rate of anybody in the free world. When you go through the losses and then back up into underwriting and profitability, that rate increase is so much more dramatic. Does that make sense?
It could be, or the underwriting action is more dramatic,
right?
Or both,
right,
or both.
It's kind of like I heard a property investor one time, multifamily property investor, 300 plus units per deal, say that having too high of an occupancy rate is a bad thing. He doesn't want to be 100% occupied because that basically says that his rent's not high enough.
Right.
Just like you don't want to be 70% occupied. You have to find that happy medium. And I think the same thing is true with insurance.
Right.
I would honestly rather write somebody a policy
with a moderately low rate than a ridiculously low rate for a lot of reasons. One being that we don't have to handle the increase the next year.
Right.
And two, I make more money.
Right.
And of course, you get pressure. Every company gets pressure from a competitor who is maybe able or willing to go just a little bit lower in that growth side. But I would also, you're relating, what's it going to be like when you have to start getting your rate caught up or change your underwriting criteria. I would also throw out there the consideration. Fortunately, we don't see this happen too often, but it does happen. And that is when the rate has been too low and the losses have been too high, it's the decision from the company, instead of increasing the rate and taking underwriting actions to return to profit, they choose to pull out of the state. Or they choose to, thing I mentioned earlier, they choose maybe to go to a moratorium, things to slow business down. In our state, we saw a little bit of that from some carriers after the tornado outbreak in 2011. They did things to slow down the influx of new business. Some carriers dumped a lot of business, but over a period of time, and usually it's your smaller, more regional carriers, but you will see a carrier, whether it just be an auto carrier or non-standard auto. Sometimes it is a multi-line carrier. I can think of one here just in the last few years in our state. They just make the decision that there's no time for action. They're just pulling out of the state and getting off all their exposures. And that's the ultimate bad ending for being too low of a rate and being too aggressive in your growth cycle. Or it could also be the result of just not having good underwriting practices when you're in that part of the cycle. That's just me thinking out loud. You may not find that in a textbook or anything.
Right. One thing I find interesting, and one of the reasons I wanted to do this podcast with you, is this cycle of insurance that we're discussing. We talk on this podcast a lot, Bill, about technology and innovations and automating your agency and the newest, latest, greatest, InsurTech technology that's out there that you can use in your agency. But one thing I find very interesting about this particular topic is this cycle of insurance cycle or underwriting cycle, whatever you want to call it. This thing it never stops. It's always going to be there, and every company is somewhere on this clock. They are somewhere on this clock right now, and and forever. This is always going to be part of the equation for insurance agents. And I think this podcast, and the reason that it resonated with me so much, is somehow in my mind I thought, no matter what happens in the insurance industry, whatever company I represent, we're going to always be somewhere on this continuum, on this circle. And that's why I wanted to have you on the podcast today to talk about it, because maybe next time an insurance agent out there that's listening to this either has a great rate or they're going through a period where it doesn't seem like they can write anything because underwriting won't let them. It's solely due to this insurance cycle that we're talking about right now.
That's right. It's the machine that we work in.
Yep.
It is in motion.
Yep.
And you're part of the machine. There's no avoiding it.
Right.
You're on that grid somewhere. As a company, as an industry, and as an agency,
right?
To a degree, but you're part of it, and it is in motion. It's real, and it's not going to go anywhere either.
Right.
I will say this: while I've always used it from the perspective of running an agency and just having awareness of where you are and where you are as a company and where you're going, what's next. When you go, it's been a while, but when you go on the internet and look at the insurance cycle, there is a lot of information there that is designed to help an individual understand what's going on as they shop and make selection on their own personal insurance. I don't think a lot of people would go that far to do it, but there is a lot of information from a consumer perspective and the insurance cycle. But like I said, obviously I've always looked at it from the perspective of an agency.
Well, and you know, the sad thing about it is the consumer, that the client, the prospect that we're talking to. Well, let's just go back. The client that you're talking to, who did not have a claim during, let's say, for the state of Alabama during the 2011 tornado outbreak. In their mind, when you speak to them a year later and the rate goes up, the first thing they say to you is, well, hell, I don't care if y'all paid out $3 billion in claims. I didn't have a claim.
That's why you buy insurance.
Right. Right. Yeah.
Right.
Exactly.
But again, I mean, that gets off into another
Right.
channel about the whole insurance mechanism, where many people pay in a little bit to pay for the large losses that only a few have by proportion. Now, the insurance cycle might come up in a sales presentation if you're selling to an economics professor over at the university.
Right. Exactly. Exactly. Well, I'll tell you where I think it could be helpful is in planning from an agency perspective, especially for captive agents, where they're looking to they're thinking about maybe hiring a new producer or something like that.
Exactly.
If they can figure out where they are in that insurance cycle, it makes that decision that much easier on whether they should or should not hire somebody based on the fact, you know, if I was working for, let's say, Allstate or State Farm or Farmers, Nationwide's kind of out of play now because they're all going independent. But if I'd been in that growth cycle for a couple of years and we'd just been writing the hell out of insurance, well, you know what's coming. And
Oh, yes.
Don't go out and hire 3 brand new personal lines producers when you're 6 months away from going back into the underwriting phase of the insurance cycle. So one question I had, and I'll let you go, Bill. I know you need to get off and get back to work, but how long, typically when a company goes into growth cycle, and you've been doing this a long time, how long do they typically stay in there, or is there a standard number of years or months that they stay in that growth?
I would say right now, I have experienced what I would call a growth, part of the growth cycle for probably the longest period of time in my history. Seemed like before, and of course, before I'm speaking more as an exclusive captive agent, where you don't have as many viable alternatives as you do now, but still, for all carriers that we represent right now, I would say 3. You know, we've been at 3 years. Things like, well, you don't have to take photos, you don't have to submit photos. They're not checking things on your renewal book when they come up for renewal, like they do during the loss portion or the underwriting portion. Those things have been gone now, or have been lightened up on dwelling or commercial building inspections ordered after the business is issued. Those have diminished to almost nothing. Right. And even on renewal business, it's like maybe 1 out of 50. But anyway, you see. It seemed like that's been on a sliding scale down, going away for about 3 years now, which kind of makes me think, are we getting close to getting out of the fun part of the cycle and heading back into the underwriting? But I'm not really qualified to, make a projection on that, I guess, because a lot of it's going to be tied, I'm sure, to economic conditions as well. Sure. Which, based on some of that, this may be one of the longer periods that I've been in for carriers to be acting like they want to write business, and because it's, like I said, I would say it's been going at least 3 or 4 years, and I don't feel like the end is in sight. Used to seem like for every 3 years that we were in a underwriting to kind of more of a hard market. For every 3 or 4 years there, you spent 1.5 years in a growth, and then you were back on the other side. Or they never let go while they tried to write more business. They never let go of the underwriting projects that made it harder to write business or harder to renew business. Right. And they seem to be letting go of that a little bit more now.
Well, I just want you to know how much I appreciate you coming on the show today. Guys, listen to me. the next time you either have an unbelievable rate and you're running around the office doing the happy dance every day because you're writing 60 policies a month, or the underwriter starts on a niche business that you're doing, asking for things they've never asked before, you will know now where you are in this cycle. And you are always going to be in this cycle. There's never going to be a time when you're not somewhere in this cycle. And I think for independent agents, it's probably a little easier because you will have multiple choices in places you can take that business. But then again, you're churning business and you're playing defense just to keep what you got, and you're moving business around all the time. So that's another factor to play into this. But I think our audience today now, Bill, will understand a lot better about the insurance cycle, the underwriting cycle. And hopefully, moving forward, it will answer questions when they start throwing stuff around the office because they just took, 15% rate increase on a line of business that they've been writing the hell out of for the past 2 or 3 years. So,
yeah, I would encourage them to. This is not going to answer a lot of questions. Maybe just open the door. But if they're not familiar with it, I would encourage them to spend a little time, go online, and do a little research about the cycle,
right,
and see how that it can help them as they manage their agency and move forward.
Mm-hmm. I'll tell you something else you can do too, and you and I have experienced this, you more so than me, but you can start listening and looking at emails that you've got coming out from different carriers and the verbiage that they're using in those emails. that starts saying stuff about profitability and underwriting and growth and losses and those types of things. And you can literally just pick and choose the words that they're using and kind of tell where they are in that insurance cycle. Would you agree with that?
I sure would. And to broaden that a little bit, if you watch their television commercials or listen to their radio commercials, if they start talking about things that are of service and benefit versus cost and savings, get ready, here it comes.
Right.
When they quit talking rate, that means they're not going to want to talk rate.
Exactly.
And they want to start talking about things that would make you want to stay with the company, stay with an agency.
Right.
So you might be tipped off through their email communications, but also their commercials to the public.
Right. Well, Bill, thank you so much for being on the show today. Guys, like I always tell you, get your ass out from behind that desk today and go out into the big bad world and sell insurance. Make money for your family, for your wife, for your husband, for your kids, for your parents that are struggling out there. Write good business for the agencies that you represent, and write good business for the companies that you represent. Bradley Flowers, I love you.
Thanks, man. Thanks, Bill.
Bill Cochran, I love you too, brother.
All right, Scott. Hey, I appreciate talking with y'all.
No problem. Guys,
Bradley, have a good one.
Yes, sir. You too.
Guys, you are listening to the Insurance Guys podcast, and we'll see you back here real soon. Take care. Thanks for listening to the Insurance Guys podcast. If you need to know more about me or you need to get in touch with Scott, you can always reach me at theinsuranceguyonline.com or email me at iprotectins@gmail.com. And if you need to get in touch with Mr. Bradley Flowers, go to bradleyflowersinsurance.com or email him at bradley@saralandinsurance.com. Guys, we love you. Thank you so much for listening. We look forward to being with you again real soon on the next episode of The Insurance Guys. Take care.